Hi everyone, this is Demel Gonzalez of Heartwood Financial Services. Hey, thanks for joining us for our latest monthly market update and outlook. Now, I make these videos because you get so much hype and so much spin in the media today. I like to show you the things that are really relevant. They're going to affect you and the economy and your portfolio. So today's topic is, where is the recession? So let's get right into it. Alright, so here are the asset class returns as of the end of July. The beginning of 2023 has started off with a bang, as you can see by the blue parts of the bar chart. That's all the month to date, so it's looking really strong in pretty much every asset class. And the green is the year to date, so we're having a pretty good year so far. I will highlight a couple things. First, you're seeing commodities up, way up for the month of July. You're seeing emerging markets, developed markets, and even small cap stocks outperforming large cap stocks. Those are all signs that the market is broadening out. And so this is a sign that maybe we're past a recession and we're starting a new recovery. And I know this is a little strange to see since we've been anticipating a recession for so long. So that's what we're going to dig into a little bit more in this video. So where is the recession? Well, I'll tell you, it didn't start in the second quarter of 2023. As you can see by my graphic here, the second quarter GDP, which is the gross domestic output for the U.S., was up 2.4%. That's actually a very healthy upward movement for the second quarter, or any quarter, especially when you have the Fed trying to slow down the economy with all these rate hikes. So the economy is looking very resilient, and that's part of the reason why you're seeing this broadening out of the stock market beyond just those big large cap names. From our asset class returns, you saw commodities went way up for the month of July. Well, a lot of this has to do with oil prices. Here on this chart, you can see that oil was up 12.7% for July. This is the biggest spike we've seen since way back in January of 2022. Now, if you think about that, that was right around the time when Russia was surrounding Ukraine, getting ready to invade them. And in anticipation of that, oil prices were going up. So this is a pretty big spike. And this is kind of the irony of the economy starting to look a little better. It actually is making inflation worse. And so the Fed has this battle here. They can't allow the economy to get too strong because inflation starts to creep back up. And of course, they don't want the economy to crumble. So they're in this weird twilight zone space right now where they're trying to do both, and it's very, very hard. So let's get more into the outlook here, what's coming up. All right, to start out the outlook, we're going to again start with inflation. This is the crux of what's driving the Fed, which is driving the markets. So instead of getting all wonky and getting into the numbers with you, which I've done many times here, I wanted to just give you this metaphor. You see this gentleman here doing some weights. If you've done exercise, especially with weights, you know that the more reps you do, the harder and harder it gets, right? Those first few reps, you got a lot of energy, you're feeling good, it's not too bad. But once you start getting into, plus 3, 4, 5, 6, depending on the weight, right? It starts to get a lot harder. Okay, and so that's what I'm trying to say about inflation here. We went from way high in the 9% range all the way to 3. And what I'm trying to say, it wasn't easy. It was definitely hard. I mean, the Fed has done a lot of work already, but it was a lot easier than it is going forward. Because going from 3 to 2, we might actually go up a little bit before we get all the way down to 2. The comparables now, over the year-over-year numbers, are a lot lower than they were from a year ago that have now all fallen off in the calculations. So when you look at the inflation going forward, it's going to get stuck. It's going to take longer. It's going to be a lot harder, like those last few reps. So the Fed still feels like they got a lot of work to do. And what I'm trying to say here is the Fed is not quite out of the picture quite yet. Alright, so here's another thing that concerns me a little bit about this market rally here recently. We're getting to the point where the stock market is starting to get a little bit expensive. So this is a chart that shows the valuation of the stock market over time, and you can see where the average is right around this middle green line. And so we're quite a bit above that. We're starting to get to the zone where it's one standard deviation above the mean, okay? And so once you get above there, it's usually when the market is anticipating very high earnings growth. And so right now, we're actually seeing earnings growth kind of slow down. So something has to change. Now, I will say earnings have been resilient. They've actually been showing up better than we've expected, but they're still slowing down. So the fact that the market is getting more expensive as earnings are actually slowing down, to me, is not a really great sign. It's a sign of caution. Alright, so last chart here before we get into the implications. But I thought this chart was the perfect way to explain why we really haven't seen a recession and the economy is still just kind of clipping along like the Fed hasn't done anything raising rates. So here's, I think, a very strong argument. You look at this blue shaded area. It looks like a giant mountain, okay? This is Mount Everest pile of money that came from all the stimulus. It came from everybody cooped up in their houses. They couldn't go and spend the money. But now the pandemic is pretty much over. People are getting out. People are spending. They're spending money on experiences, right? Because that's what we weren't able to do. And that pile of money is dwindling very quickly. We are down to $0.3 trillion in excess savings as of the last report. And at this rate, we're probably going to be done with that excess savings by the end of the year. And so my argument here is that when there's money in the bank, and we love to spend, as U.S. consumers, and the U.S. consumers is 70% of the economy, it's going to hold up pretty well, even if the Fed is throwing all kinds of fireballs at the economy here, raising rates. That's why we've been so resilient. And I'm afraid that this could change here because by the end of the year, that excess savings will probably be completely drawn down. And I think we're going to start to really feel more of this recession. Now, again, I'm not anticipating this horrible recession like we saw in 2008, but it is going to be a slowdown that we will feel, and I think the markets will feel a little bit as well. So we're still enjoying this excess savings, and it may last for a few more months, but I think we're going to start feeling that recession maybe towards the end of the year. Alright, so here are the Heartwood implications. If you watch my videos regularly, you know that last month I said that I was really close to maybe bumping up the risk a little bit, and I was looking for the market to broaden out. Now, it actually started to do that, but I haven't changed my allocation. And if you watched the video, you saw that I have kind of a cautionary tale in the outlook on what's going on with the economy. And so I'm still being kind of cautious. I'm keeping the neutral allocation to stocks versus bonds, and pretty much continuing with what I've been doing and adding a little bit more safety with the bonds, adding to the more resilient large cap domestic stocks, reducing cash to take advantage of the fact that maybe rates down the road will probably be going down here really soon. Now, I don't know how much longer exactly the market's going to be able to hold up and be resilient, and there's a lot of FOMO right now. People are going in not because they necessarily think the economy is off to the races. They're just seeing everybody else making money and they want to join in. So, the pendulum can sometimes swing a little too far, and that's what happens. So I don't want to get caught up in that FOMO. We're going to stick to our neutral weightings, which has done us very, very well. And as we see this slowdown continue to take place, that's when I'm going to start to be a little bit more opportunistic and potentially start changing the allocation. But for now, we're sticking to our guns with our neutral weighting. And so if you have any questions or any comments, please let me know. But I hope this was helpful, guys. Thank you for watching, and God bless.